Boom, baby. How's it going? Gorilla Gang, how is everything? Space Apes, how's it going? And Neanderthals, how is it going? Let's get this bread. We are here with the Moon Platoon, and we have some major takeaways from the second GameStop hearing. This is written by Ms. Alexis Goldstein herself, right? She was one of the major witnesses, and she had a lot of thoughts about exactly what Robinhood should do to make things right, and exactly what Robinhood and other malicious agents did wrong. From potential conflicts in payment for order flow, to risks hedge funds might present to the financial system, to whose fault was it that Robinhood halted GME trading. The second House hearing on GameStop covered a lot of ground. If you watch until the end, I'm sure you are going to be well prepared for Quadruple Witching Day, which is coming up tomorrow. Let me actually change this for GameStop, and let's begin. So, on Wednesday, March 17th, she testified before the House Financial Services at their second GameStop hearing. You can read their written testimony in full and watch the hearing here. You can also watch the hearing on my channel. The live stream is already posted right down below. Whose fault is it that Robinhood prevented GameStop by others? Probably Robinhood's. Wow. Right there. She said it right there. Probably Robinhood's fault that Robinhood decided to prevent everyone from buying GameStop. Remember this, the wound is still salty. I am still feeling very salty about that. One of the themes that many Republican lawmakers hit on throughout the day was this idea that perhaps wasn't Robinhood's fault that they and other brokerages prohibited purchasing GameStop stock on January 28th. Many Republicans seem to echo the excuse made by Robinhood in a blog post, blaming the lack of real-time settlement of trades for its trading freeze. I think this is likely a red herring. So she does not believe the excuse. She does not believe the excuse that this is because Robinhood didn't have enough money for the clearinghouse, right? This is the current explanation of why Robinhood made a big whoopsie and allowed the squeeze to basically be choked right before it started. Long before Robinhood faced issues raising capital to meet clearinghouse requirements, it had a track record of outages and design failures with tragic consequences. Over a series of several days in late January and early February, Robinhood drew down at least several $100 million from its bank credit lines and then raised some $3.4 billion from investors. Bloomberg reported that Robinhood was going to use the bulk of the funds as collateral at DTCC's clearinghouse. Bloomberg's Matt Levine said that the Robinhood's investors got a substantial desperation discount for their emergency investment. Separately, Robinhood is in talks with banks to raise another $1 billion of debt. Now, actually, that's something really exciting to be able to ask if she has heard about the $3 billion margin call, because if she added validity to that story, boy howdy, I think a lot of people would be really, really angry. Okay, so in a blog post on February 2nd, 4 days after Robinhood halted trading in GameStop, Vlad Tenev wrote, 2+2 settlement exposes investors and the industry to unnecessary risk. Miguel Rodriguez is asking when the four Hodelmen are going to be together. Guys, be prepared. Tomorrow, we have no set schedule, but you guys are going to expect us on all four of our channels. That is going to be real fun. The charity live stream, set your calendars. It's going to be all day tomorrow. It's going to be a blast. Fingers crossed that my Wi-Fi doesn't crap out. A child of mine, child of God, J. Meyer, thank you so much for joining the Mo Monkey Army. Let's see. While there are certainly reasons to move, to me this seems like an attempt to blame what may be a failure to manage Robinhood's own internal risk on an industry-wide settlement standards, right? So this is already like saying, oh man, it's so hot. I wish I didn't have to kill someone. Bang, bang, bang. If you guys watch the L'étranger, The Stranger by Meursault, that is a really good book. Let's see. Well, actually, Meursault is the writer. Who wrote this book? I'll figure out later. While there are certainly reasons to move to settle trades faster, which I discussed below, I think it's safe to assume that most broker-dealers have many employees dedicated to estimating what amount of capital they'll need to provide to their clearinghouse on any given day. Proper planning and ensuring you have enough capital to give the clearinghouse in times of volatility, it is part of running your business. It would be helpful for the committee to ask Robinhood how many employees, including how many quants, were building and monitoring their internal capital models prior to January 2021. I suspect the number might be significantly lower than other firms. Ooh, Darn, I wish they asked this question. Exactly how many like quantitative developers, quantitative traders and analysts were actually taking care of these models that were doing all of this high frequency trading? Like Robinhood is just starting to become more and more suspicious as we open our eyes. Basically, the world is auditing Robinhood right now, and they're not liking what they see. Ooh, baby. Okay. Now, sidebar, what is a clearinghouse? What's capital? Guys, she's going to walk you through it right here. A clearinghouse is an entity that sits between brokerages and acts to mitigate the risk of any one individual broker failing. There's a helpful discussion of this in the committee's memo for the hearing if you'd like to learn more. The Depository Trust and Clearing Corporation, DTCC, a member-led holding company that is responsible for clearing and settling much of the U.S. stock trades, facilitates the clearing process by serving as a centralized clearinghouse for more than 50 exchanges and equity platforms, processing trillions of dollars in securities transactions daily. You can imagine them as the Godfather, essentially. They are the purse string holder for the purse string holders. If you need money, well, the guy that gives you money is probably going to get their money from this guy that gives people money. Essentially, they're like a cartel head. People who need money need to have money, and if you have enough money, then this guy is going to ensure everything, and that is why the new DTCC rules are so important. If you haven't heard that news yet, go ahead and check it out. Because there is a 2-day period between trade date and settlement date, T+2, there's a risk that a broker may not be able to complete its end of the transaction by settlement date. In the sense that the buyer fails to deliver the cash or the seller fails to deliver the security, right? Essentially, it says, I would like to buy a stock. Right now, the process is within 2 days, we are going to make that trade happen, but it's not going to happen anytime sooner. That confetti that gets thrown, right? The congratulations, you are now owning the stock. None of that happens until the transaction clears. And right now, it takes 2 days. That's ridiculous. But it used to be 3 days before certain things happened, and now we're trying to push for 1 day. Let's see. Due to potential changes in market or financial conditions, including price fluctuations in the transacted security. To safeguard against a potential default by either the buyer or seller, the NSCC, National Securities Clearing Corporation, a subsidiary of DTCC, so they're kind of the same in the sense that this is like a smaller portion of the DTCC, maintains a multi-billion-dollar clearing fund, which is funded by member brokers, including Robinhood, in the event of such a failure. The clearing fund deposit amounts are calculated at least once daily pursuant to a formula established by NSCC's rules, designed to cover the fund's exposure to a given member's risk based on the riskiness of that particular member's portfolio. That includes, among other factors, a member's concentration in volatile stocks, the volume of trades occurring, imbalances in buying and selling, and the member's firm's financial condition. Essentially, this is a bungee company cartel. Everybody has a bunch of bungee cords and we're having fun. We're diving off of cliffs. It is a fun time. However, this guy is the designated driver, I guess, the DD. This person is essentially going to say, this is how long your bungee cords should be. This is how high the cliff should be. You shouldn't be taking too many crazy risks. And if you are, that's going to put all of us at risk because, I don't know, we pull together your life insurance or something and we have to pay the premium, right? If we find out that your risks are really, really high, we're not gonna, the people that calculate the premium for life insurance is not gonna like it, and being exposed to that much risk is a no-go, which is why they are incentivized to keep everybody's risk within a manageable amount of risk. There is, hold on a sec. The Democrats are concerned about potential conflicts inherent in payment for order flow. Hold on, did I miss a thing? No. Yeah, okay, here we go. I believe it's important for regulators and lawmakers to consider how to make the true cost of trading more transparent. Payment for order flow, PFOF, an arrangement where a market maker pays a retail brokerage a preset fee for every trade they execute, obscures this cost in many ways. And many Democrats asked about the potential for conflicts in PFOF, beginning with Chair Maxine Waters. Payment for order flow, oh, is she tweeting like during? I wonder if she was tweeting like during the hearing. May obscure the true cost customers are paying. I liken it to Facebook. If you're not paying for it, that means that you're the product. Many years ago, Robinhood made upwards of 80% of the revenues from PFOF. PFOF, right? If you guys are still not quite understanding what PFOF is, it's essentially saying when you buy a stock, well, right before that transaction is made, microseconds of time will pass, and therefore that's enough time to be sent over to a person that is watching everyone's willingness to pay and willingness to sell, and that allows them to have a small competitive edge to be able to predict which direction the market is going. And if you add that all up, even if it's just like a couple of fractions of a cent per payment for your order, there is still power in data. If billions of or trillions times the small fraction of a penny, that makes still billions or even trillions of dollars. Here is the 2016 memo the SEC wrote to its Equity Market Structure Advisory Committee, asking its series of questions about PFOF. The commission pointed out that PFOF can create potential conflicts with a broker's duty of best execution. Right, best execution is a legal mandate that requires brokers get the most advantageous order execution for their customers. Brokers must conduct regular and rigorous reviews of its execution quality against competitors to evaluate if it's obtaining the best terms reasonably available for customer orders. The SEC's concerns about PFOF's potential conflict with best execution now seem prescient. Robinhood has already faced regulatory enforcement actions for past failures on best execution. In December 2020, the SEC charged Robinhood with failing to disclose that it was using payment for order flow model at all. Wow! So this was like 4 months ago. They weren't even telling everyone that they were selling your data. Wow. SEC also found that Robinhood was failing to provide best execution to its clients, costing them over $34 million due to inferior trade prices. Essentially, Robinhood takes out your ear and says, "Hey, buddy, I can help you sell and buy stocks on the internet." And you say, "Great, I would like to buy GME for $10. What's that you say? You want to buy it for $10.20? No. I didn't say that. Well, that's it, $10.20. And then they give you a worse price, even though the price you wanted was slightly less. Or maybe when you sell, you want to sell it at a high price, but what they sell it at is slightly, so you're buying the price and you buy it slightly more, or you sell it and you sell it at slightly less. That small margin and is what we are finding here, that they're giving us inferior trade prices, even when factoring in zero commission trading. Remember, originally when the commissions were in the picture, that's how Jordan Belfort, the Wall Street Bets guy, the cartoon, made a ton of money based on his commission, right? You had to be sold a stock by someone. Nowadays, none of us sell you stocks because we're not financial advisors. We're just selling information out entirely for the low price of $0. Financial education at its finest. If you haven't yet added to the subscribe count, go ahead. That count is right there live. And Mr. Avoxier is going to go and buy another $40,000 of the dip at 65K. Let's get this bread, guys. FINRA fined Robinhood in 2019 for BEX execution violations related to its customers' equity orders and related supervisory failures. Robinhood paid a $1.25 million fine. Feels like a tiny fine when it comes down to it, right? Feels like, oh, you've lied to us for years. Here is like $1 million. I feel like they make that in like a day. Or maybe like a couple of minutes, actually. In 2016, the SEC also noted that without PFOF, market makers could have incentives to quote more competitively, leading to better prices for their customers. The SEC suggested that if PFOF were prohibited, market makers might need to lean harder on the competitiveness of their quotes in order to gain the business of brokers. Thank you, Massive Attack, for the super. PFOF should only be percent on positive earnings when you cash out or liquidate. That would give the brokerages incentives to have success out of all of their users. Now that is a beautiful idea. That is a beautiful idea. It should only be money that they pay when you win. Otherwise, this is a terrible incentive for essentially the broker screwing you over every single trade. Ending PFOF would not necessarily end commission-free trading. Remember, we're trying to figure out if we take away this revenue model, will it still be free? Well, here it is. Let's see. They have people in the hearing either brushed off concerns, I don't want to be political, about PFOF, or implied in that it would also end zero commissions. But As I mentioned in my written testimony, there are brokerages like Public who ended PFOF in February, but still offer commission-free stock trades. And Fidelity doesn't use PFOF for its stock trades and also offers commission-free stock trades. Interesting. Robinhood has simultaneously argued that the PFOF amounts are low, an average of, oh, here it is, here's the fraction, 0.0023 per equity share. So that's how much money they make. Wow. Can you imagine? If that's the case, it seems reasonable to expect, should Robinhood's revenue stream of PFOF end, the commissions it charges the clients would also be around the 0.2 of a penny. Would you pay 0.2 of a penny per equity to be able to have Robinhood not sell your data off and have a robot screw you over in your trade? I think that might be a pretty fair price. Yes, in the past, most discount brokerages used a flat fee model, but with a price per order rather than a price per share executed, but there's no reason they couldn't use a price per share commission model if that's what potential customers were interested in seeing. Republicans seem excited to give the SEC lots of enforcement work. Typically, Republicans are more skeptical of the SEC doing, well, much. But throughout the hearing, they kept asking former SEC Commissioner Michael Piwawar things like, isn't the SEC already enforcing best execution obligations for brokers, and highlighting the other ways that the SEC already has the authority to do look for wrongdoing. We did remember that from yesterday's live stream, which is of course true. Do they have the power to already do the thing? What's interesting is how hard Republicans seem to want to lean on the SEC when historically, at least, they have been in favor of cutting the SEC's budget, or at least opposing the budget increases the SEC has requested. So I hope, but don't expect, this is a new era where they will support a well-funded SEC. Right? Because we keep asking SEC to come in and save us, but it seems like, everything needs money. Democrats are interested in bringing more transparency to short selling. Representative Nydia Velazquez, or I guess that's the best way I can say it, pointed out that while large investors like hedge funds must disclose certain long positions, no such disclosure is required for short positions. That means that public doesn't know what amount of stock hedge funds are shorting. It's not disclosed on Form 13F hedge funds have to file. Remember, we just covered a couple of the forms that hedge funds have to file. All financial institutions have to file eventually. The reason we know that Melvin Capital was short GameStop is because they were short put using put options, and options are disclosed on Form 13F. To address this, the SEC could move to implement a piece of the Dodd-Frank law that was never implemented. Section 929XA required the SEC to write rules to ensure there is monthly public disclosure of short sales. In 2015, the NYSE petitioned the SEC for them to implement this rule, but it remains unfinished. This is really important to note, because we were talking about the fact that we just have to keep guessing how many shorts are left uncovered, and that is a big part of whether or not people think the squeeze is on or not. How can you keep this many people left in the dark and just putting their hands together and begging and praying? Like, this is just not data. This doesn't make sense in terms of data when it comes down to the modern world. Okay, many lawmakers see certain hedge funds as a potential systemic risk. Multiple lawmakers, including Representatives Al Green and Jesus Chuy Garcia, asked about the potential risks to the financial system that hedge funds might be creating. This was discussed at length in the committee's hearing memo. The market dominance of some capital market participants raises concerns about systemic risk and, in particular, correlated risks arising from the relationship between financial institutions. For example, Citadel LLC is a multi-service hedge fund and financial services company. With its subsidiary, Citadel Securities LLC is one of the largest market makers, and according to its website, executes approximately 47% of all U.S.-listed retail volume. Citadel Securities also reportedly handles almost as much trading volume as NASDAQ. Further, Citadel Securities, along with market maker Virtue Financial, account for more of the overall equity market than the New York Stock Exchange. With respect to Citadel, some have raised concerns about single market maker managing such a large volume of retail order flow and what that means in terms of pricing. Can we go a little over? Others have questioned whether Citadel has such a dominance in our financial markets that it poses a systemic risk to the entire U.S. financial system. Yeah, why the hell, excuse my language, but why the heckaroony does the hedge funds of the world and these large institutions have so much power, right? We've basically been given a Power 101 lesson on exactly what these hedge funds can do. Almost every single week, we come out with this brand new bombshell that they can start manipulating this brand new thing that we never had a agency in, and this other thing that we definitely didn't even realize they could do. Why is that? There we go. This is something that we have to consider as we move onward. One quick win for transparency into the sort of risks that hedge funds might present to the financial system would be for Treasury Secretary Yellen to restart the hedge fund working group at the Financial Stability Oversight Council. That would be great. Here's her tweet said this: there used to be a hedge fund working group at the Financial Stability Oversight Council. Before they created it, they noted no single regulator had all the info they needed to look at a complete risk profile of hedge funds. And this was shut down under President Trump. Should we push to settle trades faster than 1 day? This is one of the biggest questions. We knew this was going to be a question during the testimony prior. I'm going to drink a little bit of this coffee over here. One of the things that you guys want to be able to focus up on is that if you have a lot of the pieces here, the most important piece is PFOF and then T+1. So T+1 is one of equally important pieces that we have to put together, and that's what we're focusing on here. Another question asked repeatedly by many Republican lawmakers in hearing was about the potential move to settle trades, either T+0 same day, so like the blockchain immediately, or instantly. A couple of lawmakers even mentioned, you guessed it, blockchain. One funny exchange happened when former SEC Commissioner Pewar noted that a lot of people asked about blockchain, and when they tried to respond, they just respond by saying blockchain louder. They discussed one operational difficulty with moving to settle trades faster than T+1 in response to a question from Representative Van Taylor. Appreciated this question, she says, and discussing today on netting and why moving to settle trades faster than 1 T+1 1 day is going to have a lot of operational costs. Operational costs, come on. This was originally to protect the fact that people were shouting on the trade floor about, I need this many stock, I need this many stock. Now, the trade floor is pretty quiet, full of bots. And at the end of the day, if these bots can keep these numbers in order without having to take a whole 2 days to figure this out, T+0 and T+1 probably doesn't have that many problems. Oh, look, 969. Nice. While there are many reasons to consider moving to T+1 settlement, challenges remain that would make moving to T+0 or even real time difficult at this time. At one point, T+0 would eliminate flexibility some market participants rely on and prohibit netting, which allows transactions to be netted together even if the trades execute over tens, hundreds, or thousands of separate orders. As the DTCC wrote, allowing trades to net settle reduces the total amount of cash and securities that have to go back and forth throughout the day and eliminates a significant amount of operational and market risk. Losing the benefit of netting would create significant new operational costs. Rather than pushing out to T+0 or real-time settlement before the industry has made it to T+1, Congress and the regulators should instead examine if broker capital standards as they are today are adequate to withstand periods of extreme market stress. Interesting. Well, this is her own testimony, and she's the one that's been pretty bullish on on reducing the clearing time. I would say that one of the most important things to note is that this is kind of like saying our bicycle needs 4 wheels, but right now let's just add 1. Right? One is probably still going to have the same issues as not having, you're not having enough of the solution, right? You already know what the solution is, and yet you're not having enough of it. Very rough. Data gaps and public blind spots. Another question I have is, what are the over-the-counter options trading activity in GameStop or the most volatile days? While some of this information is likely available through expensive proprietary data tools like the Bloomberg terminal, this isn't information easy for the general public to access. Very true. From their own written testimony, major Wall Street institutions may choose to trade equity options over the counter when large broker-dealers trade bespoke options with each other instead of through the standardized, thank you for the super, Jaxie Lee, I will talk to you in just a second, instead of through the standardized options available on exchanges. But Wall Street firms typically still hedge their positions by buying or selling listed stock. Hedging is a way to minimize risk of large losses by trading an offsetting position. We've talked about this before, right? We've talked about how you can buy a long position and then buy a put position, buy a put, so that just in case the stock ends up performing poorly, you essentially pay for insurance, and either way, you'll be okay within a certain margin. If the stock doesn't go anywhere, you just end up losing money. When trading options, many Wall Street flow trading desks employ a technique called delta hedging, my goodness, where options traders try and insulate their portfolio's value from move up or down in the price of the stock. We've talked about delta hedging a ton, even delta spikes or even delta squeezes that relate to how gamma squeezes occur as well. They do so by purchasing or selling a stock against the options they trade, right? If they've been naked, they can just cover it, and that way their risk profile is a lot less dangerous. Having a sense of the volume of over-the-counter options trades in meme stocks like a GameStop, Nokia, BlackBerry costs, and AMC from January 21st to the February 4th, 2021 would provide a bit of a window into the role large institutions played in the GameStop's volatile run-up and down in price. Speaking of volatility, GameStop is not facing much, and neither is AMC, just trading as sideways as can be. Still stuck at 201, about an hour, about 30 minutes to an hour after hours begin. Thus, regulators should examine the trading volumes that institutional players made in over-the-counter equity option market and dark pools during the period of extreme volatility in GameStop trading. In addition, lawmakers should evaluate if there are data gaps or points of friction in current reporting regimes, and if so, work to bring more transparency and speed of reporting to over-the-counter options. The SEC should also work to finalize the consolidated audit trail, first proposed after the 2010 flash crash, where in just 10 minutes the Dow Jones Industrial Average lost 1,000 points, nearly 9% of its value, only to recover shortly thereafter, and now long delayed. So, with all that said, finally the conclusion, the big picture. In her op-ed for the New York Times, she tried to put GameStop in a larger perspective. Yes, many retail traders have done extremely well this year. Others have unfortunately likely bought at the top of GME. And realized some losses since. While apps like Robinhood proclaim they want to democratize finance, I think a better solution is to rebalance our economy so that no one is left behind. No ape left behind, especially not during a pandemic. Instead of creating policies that benefit the wealthy or large corporations, we could guarantee shelter, provide baby bonds, make higher education free, and cancel existing student debt, which President Biden has the authority to do without Congress. Oh, all of those four things Biden could do without Congress, or you could try to chase the latest gold rush play. Sometimes it works, but I think there are less risky ways to organize our society, and I think it's worth pursuing public policy that lifts up everybody. Ms. Goldstein, if you want to be able to take care of the policy side, we will be here buying and holding. And remember, she did say buy and hold together, so she is a real ape. She seems to be on our side. So what do you guys think, most importantly, if you guys had if you guys had a little bit of knowledge that you learned from this video, let me know how you've learned something. Also, thank the people on this part of the end credits. I really do appreciate everything that they do, and we'll catch you guys on the flip side.